Alphabet's is entering its most capital-intensive period in its history, excluding the smartphone boom period. But this time, it is not just scaling distribution, it is creating a differentiated AI platform across silicon to software. The success of the company in converting cloud backlog and AI subscriptions into persistent free cash flow will reveal whether current 24x forward earnings multiple is conservative or stretched. I believe Alphabet retains upside potential, with risk reward hinging on whether its CapEx cycle translates into durable operating leverage. If AI subscriptions scale and there remains such margin path of cloud, then Alphabet could compound cash flow at more infrastructure utility-like than cyclical ad platform rates. For long-term investors, Alphabet still offers a favorable risk-reward opportunity with short-term volatility of free cash flow offset by long-term strategic advantage as a vertically integrated AI leader of hyperscalers. The bet is not to ads resilience per se, but Alphabet becoming the AI age default operating platform. Alphabet's Q2 Google Cloud revenue reached $13.6 billion, up 32% year over year, highlighting its transition from a loss-making side business to a major profit driver. Cloud operating margins doubled to 21% from 11.3%, now on par with Microsoft Azure's profitability path. This is not just the result of broader market growth, but of Alphabet's deliberate strategy to differentiate through end-to-end AI integration. At the foundation is infrastructure, where Alphabet's TPU systems deliver roughly twice the power efficiency of competitors, 50% greater performance, and higher cluster throughput. Given that power has become the most constrained resource in AI data centers, such efficiency gains are critical. Investments in liquid cooling and optical networking further improve scalability, latency, and stability for AI workloads. This infrastructure advantage is already attracting top-tier demand, with 9 of the world's largest AI labs using Google Cloud. Layered on this base is Alphabet's model ecosystem, led by Gemini 2.5, now serving 9 million developers. Combined with software frameworks like JAX and Pathways, these models create a self-reinforcing cycle where data use improves performance, leading to wider adoption. Unlike Amazon, which primarily resells NVIDIA GPUs, or Microsoft, which ties its AI future closely to OpenAI, Alphabet integrates across hardware, models, and software. This vertical integration enhances margins, strengthens differentiation, and creates customer lock-in, as firms using Gemini within Workspace or BigQuery are less likely to diversify across providers. The broader implication is that Alphabet is positioning itself as the cost-performance leader in AI infrastructure at scale. If successful, it could build a platform business where each new customer not only drives revenue, but also improves efficiency, reinforces competitive advantages, and opens monetization opportunities from cloud infrastructure to AI agents deployed across industries. The other side of Alphabet's evolution is capital intensity. In Q2, it absorbed $22.4 billion of CapEx, roughly twice as much as in the year-ago period, and raised full-year guidance to $85 billion, up from $75 billion. Two-thirds of it goes to servers, and the rest is spread over data centers and networking. Depreciation rose by 35% year over year as well, and will pick up further in Q3, constraining near-term free cash flow. That spending rate equals or exceeds AWS and Microsoft Azure's CapEx cadences in previous years. The bet is that cloud backlog, now at $106 billion, up 38% year over year, translates into steady, high-margin revenue streams that more than offset depreciation drag. CFO Anat Ashkenazi supported that capacity additions will continue to be constrained up to 2026, signaling that demand is ahead of supply. If true, that underpins the spending cycle. Alphabet trades at a premium to its sector with higher PE and EV multiples, but these valuations align with its historical averages and are justified by its positioning as a AI hyperscaler rather than just an ad tech company. The long-term opportunity lies in its transformation into a vertically integrated AI infrastructure platform supported by a growing cloud backlog, proprietary silicon, and efficiency gains. However, this shift comes with heavy capital spending, regulatory scrutiny, and execution risks that could compress cash flow and challenge returns. Investors face a trade-off, short-term volatility and downside risk, against the possibility that Alphabet becomes the default AI operating system with strong, sustainable free cash flow. Microsoft announced a record $30 billion investment in the UK over the next 4 years, with half of it dedicated to building cloud and AI infrastructure, including the country's largest supercomputer powered by over 23,000 GPUs, in partnership with Nscale. The company frames this as a move to expand opportunities across the UK and the US while strengthening transatlantic tech ties. I believe Microsoft is one of the strongest companies in the market with excellent fundamentals and solid long-term growth prospects. However, I won't be buying it right now since the stock looks too expensive at the moment.